Okay, hello there, traders. Welcome to the TOGS Trader Podcast, episode 15. We are here. Okay, we're clicking along there. So thank you everybody for joining us. Thank you everybody who subscribes or comments or likes the podcast. We really like it, and thanks for the feedback we've had from people as well. We do appreciate it. If you've got any comments or thoughts, we're always open to it. So TOGS podcast, okay, talking about the reality of trading with my good trader buddy and friend Ian. So today we're going to be talking about scaling up, right? Something that pretty much all private traders are going to have to work with, and how you deal with that. Okay, so there's plenty for us to discuss about that. So looking good, Billy Ray. How you doing, Ian? How's life?
All right. All right at the moment. I was down in the other side of the country, down in Mayo last week.
Yeah.
I was down trying to getting a roof fixed with roofers and all that kind of stuff. So that was quite a big week. And unfortunately, I did a stupid thing. I didn't stop working when I was down there. So I was running out in the morning at 7 o'clock in the morning and picking up timber after them, because it's a large roof, and they stripped tons of timber off the roof, and came in and then was making mistakes, because it was like having everything that I could possibly do stupidly, done stupidly, basically. And I was carried on a bit this week, but I think it's just, I'm just having a slightly off period for myself. The markets have been lovely, and the markets have actually been much more predictable, because we've had a down move, and what's happened basically is that it broke over a daily trend line, and then it's relatively easy for the first couple of days to know that if the longs, because once they had 6 down days. And that basically means that there are going to be people out there who want to take profit at that stage. They're in it long enough. They've significant profit. Their own rules would tell them that they're going to have to, that there's a possible bounce coming up. And so price broke through a trend line and bounced up, and that was relatively simple. And then there was some follow through the next day, which was relatively simple, which I didn't exploit as well as I should have. And today, now we're day 3 of green days, and you can see that there's no news, I don't think, out later today. I'd have to check it, but you can see that the range isn't in it this morning, simply because people are waiting to see what's going to happen. They want to see if it's going to carry on and go green. It's in a resistance area, so they want to see if it's going to go green. So it's just basically people sitting and waiting for a decision to be made in the market. And that's what you have an awful lot of the time, is that you generally have 2 phases in everything. One is the market decides to go down, market decides to do something, and then people join in, because you have a lot of conservative traders, you have a lot of huge conservative traders, you have a lot of traders in hedge funds that are hemmed in by rules that they cannot create moves, they have to join moves. And so that's where we are basically today, is to see if that happens. So I've been watching that all morning.
It has been I think April's been a pretty interesting month and stuff. And I know you don't particularly like bearish markets, all right? Okay, you prefer bullish markets, where I love shorty markets. Price is the anvil and I am the hammer. And and that's it. I love shorting markets, all right, for various reasons. But yeah, even I know the last week was great, but it was always going to be a little bit of a turnaround, even if it's just a dead cat bounce, which is what we've seen the last couple of days and stuff. So yeah, so we'll see how they if you think about it, what are we? How many trading days of the month have we got left? Really, fully? What? Maybe 5? Is it maybe 4 or 5 and stuff? Top of my head. So it'll be interesting to see what how the last few days of the market sort of portray themselves, and so how we end up with April. I think April's been the most bearish month in a couple of years now, I think. So I'm sure the real stats guys watching this will be able to correct me on the exact data. All I know is that when the market's bearish, I want to hammer it. So but there you go.
Yeah, just one of the things with it is it's really used. It's sort of cycled into using really simple setups as well at the moment, which I kind of find simple, which I find nice. It's using just basic 5618s, all the way down, and extensions all the way down. It's been technically not that difficult actually of a market as it's come down, and it has not been that technical of a difficult market on the way up so far.
Yeah, and the challenge. was going to say the challenge you might have on bearish markets is that if like me, so if you don't always get the pullback you want, okay, because more markets are collapsing, they are collapsing, and so you have to be. I don't really particularly like trading breakouts. I'm always prepared to trade pullbacks, but when markets are sliding south quickly, you don't always get that pullback. So you have to be able to adapt to the environment. There's always the case of there's what you want and there's what you get, all right, and you have to adapt to what you get from the market and stuff. But nonetheless, it's all a good bit of price action. So. Yeah, and also I suppose I should also say before we kick in is that we did a little test additional session, didn't we, the other week? Just looking at an hour in the SP or the AS and stuff and what have you. And there wasn't really much trading day that day because we were in front of Powell speaking later on and stuff. But the people who've seen it, thank you very much once again for your thoughts and your feedback. It might be something we might do, I don't know, maybe once a month or something. If it's something that would be of interest, put it in the comments or send us a note and stuff. So, thanks for that. All right, so let's have a talk about today's topic on episode 15, right? All about scaling up as a trader. Now, listen, admittedly, we're private traders, and I suppose we're mostly focused towards private traders. But I would suggest that all traders, regardless of whether you're trading, at home, in a physical prop shop or an online prop shop, or if you're a small institution or a major one, you're always looking about how being able to scale up your trading, aren't you, and to leverage your efforts. So, what have been your thoughts? What have been your experiences about that, Ian?
Well, first of all, when I started looking at this, I looked at, there's two different types of scaling up, really. I think there's the scaling up, which is increasing your initial position size, and that's the one I kind of stuck to when I was sitting down trying to think about that. And the second one is adding into positions aggressively. And then the first thing I wanted to do was kind of say, what is the perfect position size? And for me, the perfect position size is small enough that it doesn't affect you, but big enough that you care. So what ends up happening, and a lot of the times when I know that I have to change, is because the position size is too small that I start not caring enough about it, and then I'll start making mistakes or I'll start taking risks, and then I'll start to know that because of just simple boredom and risk taking, that the position size has to change just a little bit. Position size changing then is an amplifier, basically. So anything that's wrong with your trading at the moment is going to be more wrong when you turn up the volume, basically, and once you put in more money into it, you're suddenly going to see weaknesses in your trading and your psychology, and if they exist already, so everything has to be perfect before you move your position size, because it changes your stress level when you change your position size, and stress can lead to doing things like tunnel vision, which in trading, or at least in my experience of trading, means that you, in some sort of vain attempt by telepathy to control your risk, you end up coming down you start focusing on your trigger charts, on your very quick charts, and you get very sensitive then to every tick that's happening on your screen. So it's very easy to overtrade when you get to that little bit of tunnel vision pressure, and it's very easy to cut your winners too quickly and cut your losers too slowly when you've changed your position size. And then you can get very judgmental of yourself, because when it starts going wrong, it's a judgment on you. It's not that you're losing money so much, because I always think that money is, because I was talking to somebody else during the week about it who'd lost a significant amount of money, and it's not the money was the problem. It was that it was changing it was a loss of a dream. So when you go and you change your position size, you have you're starting to lose money. You're changing your position size because you're looking for a different type of outcome. You're looking for the fulfillment of your dreams. You're looking for the fulfillment of the reason why you went to trading in the first place. And when you start losing money and you've changed your position size and it's not going that well, you're not just losing money, you're losing that potential outcome, that imagined future, basically.
Yeah, I'd agree with that. Just on, there's a good few points there, but just even on that last point is that, it just that that loss of the dream, or the dream seeming like it's stretching away into the future, that can become a stick to beat yourself with. All right. And I talk about it all the time. Trading is challenging enough as it is. You don't need to give yourself any more sticks to beat yourself with. But I also appreciate that it's very easy to sit here as an experienced trader and say, oh yeah, you shouldn't do this, you shouldn't do that. When you're sat at home on your own in the thrust of a meltdown, whether it be the market meltdown or whether it be you, all right, okay, it's very easy to sort of sit outside and say, oh, you should do this, but the only way is for you to really is to live it. But as they always say, the smart people learn from other people's mistakes, which is very sage advice. But the reality is, most people learn from their own pain. All right, it's that pain, isn't it, that makes them make those choices, whether they be good or bad choices. So and we all have to live that. You're right with regard to I suppose in terms of scaling up, there is the kind of the scaling up your existing, let's say, financial position size. All right. But then also scaling up your overall account. You are right that you're always looking for, it's kind of like the Goldilocks. All right. You don't want your position size, too big, or you don't want your position size too small. All right. You're always looking for it to be just perfect. And the truth of the matter is, that comes from a bit of trial and refinement, doesn't it, at the start of your trading career? Okay, well, I certainly bang on at people about how you need to have a stop loss in place, you need to position size, and you really shouldn't be risking anything more than 1%, really. That, and that's people pretty much accept that. But then what you will also find as well, what is that 1%? All right, if that's that could be a difference between a 1% of a £500 account and a 1% of a 500 grand account. All right, and that has a financial number to it, and that financial number, will have an impact upon you. There'll be levels at which it triggers you. All right, for reasons you might not even fully know or understand at that time and stuff. But trying to find that at the first part, trying to find the Goldilocks level of kind of what is the position size that means you're not in distress, but equally you're not sloppy, you're not complacent, you're disengaged from the endeavor. That's not easy, and the only really way to find it is through a bit of trial and refinement, isn't it? Hence why, as I bang on all the time, you keep records and you review to find out exactly how you're feeling. If you can't sleep at night because you're worried about your position, if you're holding swing positions, that in itself is telling you something. But then on the other side of it, if you're not really checking on your analysis, checking on your position in a rightful manner, not by every tick, well, then that in itself is a kind of a bit of a disengagement, detachment from it, and that in itself is not really good and stuff. And I've seen it in the past where, let's say, people from perhaps very comfortable, wealthy backgrounds, the money is probably not theirs that they're trading. It's come to them in one or two other ways, and their detachment from it in some ways can help them, but equally it means that they're disengaged. And they don't, them losing 45 grand in an afternoon, as I saw one woman do. Didn't mean anything to her, but not in a good way, but because actually she'd never had to earn that money, didn't have a kind of an energy or a connection to her and stuff. So it's about finding that Goldilocks level, isn't it?
One of the things there with learning from other people's mistakes, I think that that's a very limited thing that you can really do. And I was thinking about I used to have fear of flying at one stage. So I used to hate getting into an airplane and flying off someplace. And you could see loads of other people arriving at the airport. They all arrived safely and they all left safely. And then they took on multiple flights. And then the other thing I was thinking about when I was on a plane one time is that the air stewardesses, they flew every day and they weren't scared about it. So they must have some sort of thing. And it was years. So I could not learn from the fact that other people felt safe. I had an emotional response to that. And the emotional response overtook the rational response of seeing other people do something safely. And it's only because it's just the way my brain works. And I went one day on the internet and I read all the statistics about plane crashes and then went, hang on a sec, this is 100 times, whatever it was massively safer than a car. that a car or any other thing, the only thing that can go wrong in an airplane really is that you have a heart attack and it takes them too long to land to get you to hospital, and that's basically it. So, and even with helicopters, the helicopter is 40 times safer than a car to fly in. So for every mile, you can do 40 miles in a helicopter for the same risk. And I was just thinking, because somebody nearly killed me on Sunday when I was driving on a motorway and they pulled out in front of me and I had to go all over the road. So I think it's a very limited thing. So I think sometimes it's by keeping your position size low, you might know that somebody has had this lesson before in their past, and then by keeping it, you're going to have to go through the same thing, but you're going through it cheaply by keeping your position size at the right size until you're ready to change. It's the primary means of risk control as well for traders is position size. There's nothing else that you can really control as much as you can directly control your position size. So, so that makes it, you should be very selfish with it, because that's the area where you can decide to do whatever you want. So it's rather than the market dictates almost everything else, it dictates whether you're going to get whether you're going to get your setup or you're not going to get your setup, or you're going to get really well paid or you're not going to get badly paid. And the last thing you just said there is something about sleep, and because at the moment I'm not sleeping that well, and it's just I go through periods of insomnia every once in a while, I suppose, for lack of a better word. I wouldn't call it terrible insomnia now. I went to sleep at probably 2 o'clock and I got up at 6, so 4 hours. It's not so bad, but it is really a killer for trading, because you cannot think properly, and you cannot think sort of in that nice linear way, and that can really just creep into your trading. It's something I would be very conscious of. But position size, it's going up too quickly is the classic newbie mistake, I think, or one of the classic newbie mistakes, that they try and they build their position size before they build their skill. And it's because when you start off first and you go into trading, because again, it's the result you want from trading is money, and you want the money to change your status, and you're in a rush to do that. And two things happen. One is they don't concentrate on what is the real thing, which is skill build, and they don't value it. Yep. So it's very hard to progress over a long period of time in trading until you really get to value skill over money, because the skill comes, then the money comes, and the money only comes in relation to the skill. There's nothing else controls it, basically. So if you want to be a good trader and trade and make whatever you want to make, you have to have the skill to do that, and that's what you need to value. And whether you get that skill and you spend, because you're going to lose money at the beginning, there's no way out of it. It's a cost. It's a cost of doing business. So you can lose €1,000 or €3,000 or €5,000, whatever it is, or you can lose €1,000,000. The choice is completely yours.
Yep.
As long as it's just enough that you feel, as long as the loss is just enough that it gives you a little pinch to help with your learning, because pain is a great teacher. Yep. That's the position size that you want, but you don't want to be going in and crying about it afterwards, and you can't afford something. And I think one of the things as well, what happens with people, because I've seen this with over the years, is to start equating, they lose €50 or £50 or whatever, and then that equates to dinner out, or £50 used to be dinner out, but once upon a time when I was having the idea first, it was a dinner out. So they lose their £50 and they equate that to an electricity bill or a gas bill or a whatever bill. They could do something fun with that. And now they've lost the money, but more than that, they've lost the opportunity of the joy of that money. And that makes it even worse, because then they go back into trading and they're thinking, oh no, if I lose another £50 today, I'm going to lose it. And the only people who actually seem to master that sometimes, I think, just in real life, are drinkers. People who drink a lot, and I know myself, because I used to, when I worked in the wine trade, and I go into a place and I'd see a bottle of wine, be like, Lynch badge for €99. Oh, give me all of them. Or whatever, you know what I mean? Because it wouldn't figure, you don't see it the same way. And I think it's the same thing that happens with trading losses. I don't see a trading loss the same as I see if I lost my wallet and there was €50 in my wallet. I'd be all like, oh no, I lost my wallet. I lost €50. But if I'm in trading and I lose €50, it's like, well, that's a cost of doing business. I think.
No, yeah, and there you go. That's a good way to think of a cost doing business. Just on your point regarding about fear of flying, you shouldn't have a fear of flying. It's crashing into the ground at a high rate of knots. That's what ruins it. Not the flying's
Yeah,
glorious. The flying's beautiful. It is basically
yeah,
in the ground at terminal velocity. That's what kind of ruins the experience for most people
yeah.
and stuff.
Well, to be
Generally,
honest with you,
flying's
yeah,
fine.
if I had the chance and I had a bit more time in my life, I definitely think about doing a private pilot's license. This is
Well,
something I
yeah,
wouldn't mind, actually really wouldn't mind doing.
a good friend of mine did exactly that to get over
Mm,
their fear of flying and
yeah,
stuff and what have you, and it has worked, helped them enormously and stuff. So,
mm,
I mean, so flying's pretty easy, mate. You know, houses get bigger, houses get smaller. That's literally that's it and stuff.
yeah,
It's not
yeah,
that actually, but anyway, yeah. Anyway, you're right in terms of in terms of that position size, pinch is a good word, all right. You do need it to pinch a little bit, all right. You need it to pinch a little bit just to basically to keep you on your toes, to stop you from getting complacent, all right. It's all human beings become complacent. I know I can. When I get into basically just things are going well into a purple patch and stuff, it is easy to become complacent, and I'm always having to be on the watch, the watch for that and stuff. And so position size is one of the ways that position size can be one of the ways that actually helps you in that. Certainly, for kind of new traders, for kind of the new traders, you're absolutely right. You're trying to acquire skill set, right? You're trying to acquire skill, and then you'll get paid for that skill set. When, well, you can't put a time on that. The market will pay you when it pays you when you've acquired the skill set. And if you aren't managing risk properly well, then you will never acquire that skill set. What I often see is, and you alluded it to yourself, is that they've been working away at the trade, now they've been working away for the trade 6 months, 12 months, etc. And then suddenly they've got themselves into a nice groove. They probably don't understand why they've got themselves into a nice groove. As in, they think they've cracked it, but it could just well be that
mm,
they're those four M's we talked about. The kind of their market method is aligned with the market, aligned with themselves being in a good space, and their money management has allowed them to do it. But they have 2 months of doing really well, and I don't know, let's just say for hypothetically that they're trading at I don't know £5 a point, okay, on their spread betting account, okay, and they're just chipping away and actually done okay. But of course, now they think, I've cracked this. All right, step aside, Paul Judah Jones. There's a new lad in town. Here we go. And suddenly, they scale up and they're going from like trading at £5 a point to £20 a point, 25, £30 a point. Okay. And suddenly that's what starts to trigger them. And it's almost it's almost like you can see the peak of their equity curve is the day before they decide to scale up, and then their equity curve is just like,
mm,
it's in one direction because they've overwhelmed, and they've gone from losing, as you say, they've gone from losing like 50 quid on a trade, all right, to losing 500 quid, on a trade and stuff. And it just basically, it's more that they've generated in the last 2 months and stuff or something like that. And that just basically scrambles their little brains. And then what happens is then they kind of, instead of sort of stopping and assessing, they generally double down. Okay. They try and double down, the loss aversion bias kicks in. And instead of saying, do you know what, I've scaled up far too big, far too quickly here, they basically keep on it thinking, well, do you know what, it'll turn around. I've got to, I had the gambler's fallacy. It'll come good. It'll come good for me. The next trade will be a winning trade. And then they're into that kind of death spiral and stuff. Rather than, and they're doing that because they've been working hard. They want reward for their efforts, endeavors, and as you say, they want to change their status. Okay, we've talked about it before. They've got external drivers. They hate the job, they hate where they live, they hate the car they drive, the relationship they're in, or the relationship they don't have, and they want to change that as quick as possible. And they see trading as that vehicle to take them there, and so they ramp up far too quick, and it rarely ends well. It rarely ends well. It's when it comes to scaling up, you have to do it, but it should be very slow and steady. It is just like literally chipping away at it a little bit, isn't it? If you just go too big too fast, you should not be shocked when the rug gets pulled out from underneath you, and you're just given a bit of a punch in the face.
Yeah, sometimes I think, to be quite honest, trading mentors push them too fast to move up their position size too fast. Because what I've seen with trading mentors when they're selling courses and they're doing the initial, the person rings them up and they're having the initial conversation with them about doing the course, and they explain, they explain in basic terms what their setup is, and then they explain the scaling up. And scaling up is generally is too aggressive for their students. So they say, right, okay, you do this setup, and then once you've had 20 trades, we'll say that have gone, you've had 20 out of 30 trades go your way or something like that. Whatever the rules are, it depends. That you double your position size. And then when you do it again, you double your position size. And then very soon you're at 30 or 50 or €100 a point. And you're making $1 million billion a year. And that's part of their marketing, and that's it's a very cynical part of their marketing, really, that they would do that sort of thing. Like, so be very careful of a mentor that will tell you that because they can get you from here. Because what they're doing is they're saying, I can change your status and give you everything you want in this short period of time, and nobody can do that because it takes as long to do it as it takes for you to do it. And it's one of the
as long as it takes.
That's one of the things I was going to say later on. Is that,
and if I might just very quickly include that, so that probably that kind of leads us to a good point, because this is episode 15. The next week's episode 16 is about trading education and stuff, and is it worth it? So be sure to listen into that and stuff, okay? Because we'll have lots to say about that, as always. Sorry, Ian, go on, carry on.
No, so I went and I had a look at the reasons why you shouldn't change your position size. So don't change for income. That's the first thing I always think with people, because what ends up happening is they get into a rut and they want to change their income. They want an income out of it for some reason, as you say, to escape your job, escape your life, change your surroundings. And that's just pressure, because again, what you're doing is you're putting the pressure of, instead of, I think I could do this for 20% more, I can put my position size up maybe 20% more. And that might be going from €1 to €1.20. But because I feel I can, is a much different thing than going, I hate my crappy car and I want to change my crappy car because everybody laughs at my crappy car, or whatever it is. Because now your pressure, dreams, hopes, wants, everything put into your position size doesn't work. Never change in competition with others, because one of the things I come across, and especially I suppose early in the day when I might have been a little bit more susceptible to it, is you used to see loads of people on Facebook groups, although it's moved off Facebook to a certain extent, and they'd be saying, oh, I did this and I made that, and and then they'd be showing whatever they, their income statements or whatever. And naturally enough, they can be very selective in what they're showing. If they're showing a real result, they can be saying, oh, look, I shorted Tesla and I made a load of money. But then I did I had bought Tesla previously and lost a lot of money, or whatever it is. It can be fake. And 90% of people, or 95% of people on the internet in trading, have something not right about them. There's, especially in retail rooms, it's either somebody trying to sell you something or somebody looking for status. It's a person who's loud and they cannot admit to failure. So don't compete with them, because you're not competing with the ghost. Don't increase to get money back. I've lost $1,000. Now I need to get that $1,000 back, so I need to increase my position size. That's the rocky road to martingale. Obviously, don't increase to a level that your account can't handle. If you're risking 10% of your account on every bloody trade, you're not going to be there for very long. Don't increase your position size because you think this is a unique opportunity. This is a once in a lifetime thing, because there's a once in a lifetime every month, or every week. There's some once in a lifetime, and they aren't the trades that make the difference. It's the consistency. It's the small trade, the small consistent trade, and the building up of skill that makes the difference. One trade. The very exception might be if you bought Bitcoin at the beginning, for 50 cents or something like that. That might be a life-changing trade. But on the whole, there is no such thing as a unique opportunity. There's always some other opportunity. Don't increase by a fat finger mistake, which I have done myself, which basically where I've gone into get out of a position. I did this in the last week, actually, where I doubled it by accident, just pressed the wrong button. click the wrong icon on the screen and double my position instead of getting out. And that's something that happens. It happens once a month, I'd say, give or take. I make some sort of mistake like that. But the thing is that the duty then, because you're very quickly losing money, you're losing maybe double, triple what you intended to lose. So I was in some trade. I was down 200. That's where I would generally cut the line for that particular setup. And then I doubled my position by accident. And then I was down 4, and then I was down 6. Because I wasn't even quick enough in getting out of that, and I know what I'm doing. So don't increase position size for fat finger. And that was that basically.
No, there's some wise advice there. Some wise, very wise commentary there and stuff. It's I think also we've kind of got another how would you describe it? Kind of another element to it, another view on it too these days. You talked about being driven up by educators, but of course an awful lot of people are trading through online prop firms these days. So they are kind of pushed or forced to basically to scale up quicker than they should do in order to either A, hit the funding challenge, or B, to hit the kind of next level whereby their price, their allocation gets increased, whether it be by 20% or 100%, etc. Or that they want to achieve a particular watermark, to achieve a particular payout. So they have lost all their objectivity of their trading. They are literally just trading their numbers. They're trading their book. And when you lose that objectivity, you lose that perspective. You start trading your numbers, start trading your book. Once again, you're just waiting to get a tap in the face with the back of a shovel. That's what's coming your way, isn't there, and stuff. So I noticed that I say when people trade in props, and I'm talking to a few people at the moment about their journey in prop firms, etc. Once again, it's easy for me to say, oh, you just need to resist that. I appreciate it. It's very easy for me to say and say that. But the reality is it is good advice, and sometimes forewarned is forearmed in terms of understanding that, even whether your own account or whether it's a prop firm account, you kind of have to go at your own pace, finding your own pace. You're going too fast, scaling up far too fast, far too big, far too quickly. Rarely ends well, and if it does end well, it's through luck, and you won't keep it. All right, but equally, you can't. To an extent, you can't necessarily just trade at your pound of points bed betting account for the rest of your days and stuff and what have you, because that's not taking you anywhere either, etc. So there is a kind of a path to find it. All right, and we're always constantly in that, and also in terms of there will be psychological levels that impact you as well. So you will find as part of your journey that there will just be psychological numbers that just basically hit you for a reason. So for my own example was when I earned more in one day on one trade than I had done in a year when I've been in the military, like 20 years earlier and stuff. I just had a great trading day as part of a great period and stuff and whatever. I think my gross annual salary as a junior air force officer, about what would be about 30 years now, was about 23 grand a year or something. I'm pretty sure it was. And then had a great day where I kind of achieved that in one day, and it kind of blew my mind, sort of, that I used to do a very, very important job, actually really very very important job, and an awful lot of stress, an awful lot of responsibility, and for a whole year doing this, that, and here in like one day, I'd kind of, I'd achieved more and stuff. And so I kind of had a little bit of a long walk around the park to basically get my head sort of around that. And whatever. Actually, I think I took about 2 days off afterwards, just to get myself into that kind of, understanding a mentality that the world has changed, all right, in terms of how you can do it, but everybody will have particular, where it might be a particular number, like in terms of position size or what they achieve or what they lose, and it will have a psychological impact upon you. It'll trigger. Maybe you'll realize what it is. Maybe you won't. Maybe it'll be something from your childhood or what have you. But there will be particular levels that you reach that basically do trigger you a bit. They generate an emotional reaction, and all I can say is don't ignore them. All right, embrace them, understand what is it, and almost like defang it. All right, defang it. Take the kind of energy out of it by understanding what it's going on and what it's trying to tell you. Because I assure you, you will have a few of those. You'll have a few of those challenges, won't you?
Mm. I was just going to say as well, prop firms push you to weed you out. And that's one of the big
Yeah,
things with them,
yeah,
because they want to get rid of them, because they're only looking for a couple of traders, because a couple of really good traders will make back all the stuff the other traders have lost plus more. So, part of the reason that they are pushing you to increase your position size and do things that you're uncomfortable with is that they're literally trying to get rid of you, in some way. Because if you pass the test and you manage to do it, then great. That's fantastic. But if you don't, so what? Doesn't matter to them. They have found out now at a level which is safer for them than later on, maybe when you're dealing with even more money or something else goes wrong. So they are spending money through losses to make sure they get rid of you quickly, or as quick as possible.
yeah. They're not friend.
No. And I think the only way that you can actually do it in some ways is that you have to have a super tight setup. Like, you need to have like a really super tight technical setup and a real belief in your actual edge, so that I mean, you can the first couple of trades, because what I find a lot of the time as well is that when I change my position size, that I have to do it multiple times. So I go and change my position size and then it goes wrong. And I find it a little bit, because it's like being, it's like swimming without a ring or something, those lifesaving rings. And then I have to go back, and then I have to go forward again. Because I just have to get used to it. It's like immersion in this sort of, like, because it's more scary all the time or whatever. And it's like immersing yourself in it, going up a little bit higher, maybe going from a plane to a helicopter, whatever it is. And I think that, the when it comes down to getting paid, because there are days where you work where you would make more than you would have made in your previous job in a year, or one stage myself, a year and a half. But that's because we're not paid for time. We're paid for risk. So you're taking a risk on one side. You have taken that risk, and how you get paid for that risk is completely market dependent. So the risk you've taken, you could have risked $1,000 in that trade, and that trade could have just taken off. So news could have come out, and suddenly you have $40,000 or something in your trade, and you're paid for that risk, and sometimes you just get rewarded for taking that risk. It's just life, It's so it's that's what happens with it, basically. So I would say the big chief takeaway from that, from my side, would be that it's going to take you several times, probably, to move with your position size. And I never make a large change in my position size. I might, well, except once or twice where I've, for various reasons, had to do it. I tend to try and make a small, like, incremental changes in position size, not going, 10%, 20% change in the position size, not some big massive change. Because I don't want to be overwhelmed, and I know how I'm going to react. So why bother? Take 2 extra weeks and do it right. It's not. Oh, that's another thing. I never put any time frame onto anything I do in trading, because I used to put a time frame onto, I'd have goals in trading, and I'd have to achieve this by a certain thing, and I had a date in my head that I had to achieve stuff by, and then that just turned into more pressure. I had a bottle of wine one day. I had a feeling secure, and I had it under the desk for years, sitting there maturing away, basically because I had a goal in my mind that I thought I should achieve. And once I achieved that, I was going to celebrate with this bottle of whatever mid-range wine. And actually, when I was doing in the wine trade, it has the best tasting note I've ever come across, which is Michael Broadbent said it's whatever, the 2000 and whatever, or 1997, not as pretty as the owner's wife. I don't know if you get away with saying that these days, but eventually I just took it. I just got sick of it, because it was like bullying me. It was just sitting there going, I am now going to remind you that you have not achieved this goal and this bloody wine is mature and it's ready to drink. And I took it out one day. We just went to a restaurant that had bring your own, one of these Lebanese places, and drank the wine and got rid of it, because it was just sitting there looking at me, laughing at me.
So there is There was a whole other podcast on Ian's journey into wine. There's a
Yeah,
whole separate podcast for us to
yeah,
create
yeah, yeah.
the adventures Ian had off the back of bottles of wine. But
Yes,
anyway, that's a
got a lot
different
of
story,
got
literally
a
a
lot
different
of
story
those.
for a different day. But
Yeah.
no, I understand what you mean there. You're having
Mm,
that there as a kind of a visual reminder of your failure is,
mm,
it doesn't help you because either it defeats you and it chips away at your self belief, or you get a bit grumpy and angry, and you become too aggressive because you're like, I'll show you. All
mm,
right, you think I can't achieve that goal, I'll show you, and you become aggressive and stuff. And of course, in Hollywood movies, that's what they want to see. It's that
mm,
whole kind of hero's journey and the redemption, etc., what have you. And that's lovely. It makes for a great 2 hours in the cinema. But when you're sat there kind of trading, especially if trading, good funds or other people's money and stuff, that is not the kind of emotional journey that you particularly should be going on when you're sat in front of the screens looking to click into sort of a few buys and sells.
mm,
So yeah, on that kind of that prop thing as well. There is also, I'd say, in terms of scaling up, not only is it they, as you say, drive people towards increasing their position size, but also people scale up too fast. Yeah, and I've mentioned it before, as in they've been sat at home. I don't know. Let's say they've been trading a £5,000 account at home, a spread bet account, chipping away, doing okay. They've started to get a little bit consistent, doing okay, and then they think, great, and they use that money then to buy a 500 grand prop firm account because they in their heads they've done it well. If I
mm,
start doing a couple of percent or 1% a week, I'll have got that money back, and here we go. It'll this time next year, Rodney, it'll all be that and stuff. And actually, they just go from trading like a 5 grand account to a 500 grand, effectively a 500 grand in their head, even though it's not. But they will do that, and that will just basically it'll blow their little minds and stuff,
mm,
and rarely does that work well. What happens is we have a survivorship bias. So the one guy in 1,000 who does make that leap successfully, of course, the prop firm, they basically put them up on the pedestal. Everybody wants to sort of, that optimism bias. They want to basically see the kind of the guy who's achieved it. But what is not covered is the 999 other guys and girls who basically blew up, who basically swung for the fences, and basically basically took a
mm,
fast ball in the face and what have you. So yeah, so there's kind of lots to take away in terms of scaling up. As in, regardless of whether you're on your account or on a small prop firm account, you scale up very, very slowly. All right, you're not going from £5 a point to £20 a point. Okay, you might go from £5 a point to £5.50 a point. Do you know, it might be just a little small scale up in your
mm,
position size, which should still also fit within your overall, value at risk rules, etc. And if you're doing prop firms, you need to just be aware of your prop firm's rules, all right, and make sure that you're not getting pushed by them to sort of, to sort of scale up too fast, or that you yourself are not basically setting yourself foolish expectations, okay, that are there just to basically to hinder you rather than help you. And also, if you're going to go down that prop firm route, you know, just there's absolutely nothing wrong in taking their smallest accounts. I don't know what it might be, 10 grand, 25 grand, 30 grand, whatever it is. All right. If that's where you're starting off small, start off, cut your teeth on that. Okay. Make your mistakes because you're going to make them, aren't you? And then just basically, if you can achieve trading on that prop firm, well, then basically, use any of the funds from that to then basically add bigger size, bigger size accounts and do it out of your own profits rather than sort of putting yourself under enormous pressure to sort of try and achieve outlandish expectations. So
mm.
there you go. Anything else? Anything else that we'd
Yeah,
want people to take
couple
away?
couple of little things with that. Visualization is actually I find quite handy too, because your body cannot tell the difference. So if you go and lie on
Yeah.
the couch and you visualize what you're doing, you're going to start feeling some of those emotions because your body can't tell the difference. And I was only got that highlighted during the week. I was down at home, I was watching somebody on YouTube live trading, and he was trying to go long in a pattern that I would try to go short in. And I started to feel a bit panicky for him because I was going, that's stupid. You're not doing that. That's wrong. And starting to feel the same emotions as I would feel as that if I was in the trade. And that's because my body at that particular moment in time can't tell the difference. My mind can't tell the difference between being in that in the trade or not. Actually, if authors about things like that. Joe Dispenza is brilliant for that kind of stuff. Like, you have to understand that losing is not failing. It's not the same thing. Failure only becomes failure when it's too much losing. But losing in general is not failure. So you can't. It's a distinction that you have to get in your mind, because it's such a normal part of. You can't motivate yourself past into a new thing. Like, you see all these like Tony Robbins type style guru guys, and they build you up, and they're talking to you and they're shouting at you, and you're all feeling like, hey, I can do anything. You can't do that with trading, because you can feel motivated and all chipper and great and wonderful, and then go and just screw it up, same as everything else. Because even if you're going in with this big motivational bias to trade, or big motivational energy to trade, that can just screw with you the same as feeling tired or depressed or something else, because you're not on that plane of concentrating and being one with the market. Liquidity in markets. I remember the first time going live in oil or something, and then I did some trade in the middle of the day, and I had my stop loss in at +1 tick or whatever it was, and then it went, and I had a little bit of slippage, and I was like, that's not nice. I didn't enjoy that. I didn't ask for that bit of slippage, because it was like, whatever, it was $40 at the time, which was a big enough amount of money. You start trading to not to lose, and that's what happens to me nearly every time. I change position sizes. I start trading not to lose rather than trading to win, because you become very defensive in your trading. So so I can even see the stages of it. So when I change my position size, then there's a few mistakes, there's whatever, up and down a little bit, and then I'll do things like cut my wins too short to make sure that I'm closing out at a good price, and all this kind of stuff. Like, so it's or close out green, I should say, rather than close out a good price. And I make lots of little errors until I become acclimatized to that. And I never try to visualize or imagine what I'm going to do with the income, rather what I would do with the loss, because again, I don't want to equate my trading capital. Like, I was doing something that one of the days there where I was going, how much money do I actually have? And I forgot to include my account, because it's not real money. It's just, touch wood, it's money that's there as part of a business. It's like, it's not part of it doesn't feel like part of my net worth. It feels like my tool that I use to trade with. And that was basically it. That was all my thoughts when I sat down to go through it and have a think about scaling up, which is, it's a very first world problem, because if you're scaling up and you're doing it properly, it means that you have been successful at a certain level. You have a defined edge. You have a tight setup that you're able to execute. And, you're in a wonderful place. Like, if you're doing it properly, the scaling up, and you're doing it in your own time. I mean, it is a stressful thing to do, but it's real first world trading problems. Like, oh, I'm not making enough in my futures account. I need to make more money in my futures account, even though I'm consistent at this level. It's so first world. It really is. Like,
it is indeed. It is indeed. Well, on that note, why don't we do it? On that cheery note, why don't we draw it to a close there, Ian? So, listen, thanks for joining that, and thanks for all of that insight. As always, listen, thanks to everybody for listening and watching it. Please, I really appreciate, just like, subscribe, comment, and tell your friends. Okay, spread the word about the brutal beauty of the TOGS Trading Podcast. And as I said, next week is episode 16, and we'll be talking about trading education and whether it's worth it, and so I'm sure everyone will have interest in their comments and thoughts about that. So until next week, trade well, everybody. Thanks very much, Ian, and we'll speak to you soon, everybody. Cheers.